My name is RJ Kelly. I'm founder and chief visionary officer of Wealth Legacy Group in San Diego, California. We've got clients in 21 states, and I'm also a member of a group called Elite Producer Group. In our practice, we're a multidisciplinary holistic practice. So in terms of assets under management, tax mitigation, but we also have a practice that deals with very sophisticated uses of life insurance, disability insurance. And for that reason, I'm a part of a group called Elite Producer Group, as I mentioned. And so in the course of joining that group, I met the executive director, Tom Toos. Tom said, you've got to meet one of the brightest guys you're ever going to come across by the name of Bryan Setzler. So intrigued, I reached out to Bryan and we met at a couple of our annual meetings. And Tom, as usually, was right on. Bryan is truly one of the brightest people you will ever meet and has a company that is, in terms of Optimus Life Solutions, or Life Designs, rather. It is a combination of sophisticated planning that oftentimes encompasses the use of life insurance, but also used in a very unique and also sophisticated way. So it was so much fun. We were detailing a couple of weeks ago on something else, another case design for one of our wealthy clients. And so I said, hey, Bryan, this is such good stuff. I mean, you're presenting some things that's so unique that would you be willing to come on camera with me and let's have a chat? And so much to my delight, he agreed to do that. So bless his heart, even being with us today after getting no light, no sleep on a lumpy bed in a really nice hotel. I won't ask the name, but anyway, it didn't sound like a fun trip. But despite all that, he's here with us today. So Bryan, thanks so much for joining us on camera and looking forward to getting to spend some time. And I know that whoever ends up watching these videos will find this to be some really interesting, unique things that they have never heard before. And so again, thanks for being with us this morning.
Thank you for having me.
So let's do this. We're going to start with an idea that you call your IRA life conversion. So tell us a little bit about this. Give us the high level view. What's a situation? How did this come to be started and used? And what's an ideal candidate for this kind of idea that we're going to be looking at?
Well, RJ, many clients, once they reach retirement age, have been fortunate in their life to build significant wealth. So when they originally began funding an IRA or a 401k profit sharing plan, if the original purpose was to save enough money to help them retire was the original goal, but maybe by now they've become so wealthy that it's become a smaller percentage of their overall holdings. And because the money is all tax deferred, all the money that's within the plan has never been income taxed, they find themselves in a situation where under all circumstances, whether they withdraw money, whether they die with a balance and leave it to generation 2 or generation number 3, it's subject to income tax in whatever state that they reside in. And depending on the overall size of their estate, it could also be subject to estate tax, causing this bucket of money to be, in many cases, the least efficient from a pass to the next generation perspective.
Boy, that's been my experience as well. People find out this is why I call it junk money, that this is junk money because the combined tax rates of income respected as seen plus the estate tax will put it over 70% in taxes. So only 30 cents on the dollar gets to go to the next generation. And even then, there are some proclivities that make it, that money has to come out very quickly. It has to come out over a 10-year period of time. So it is not the best money to be trying to pass along to Gen 2 or Gen 3, that's for sure. So you've got an idea about what they can do instead.
Yeah, so our firm, we have an online case request portal that populates client profiles coming in from various advisors around the country. And so the strategy that we're going to go through today is not for everybody who happens to be 68 and 65, but I just picked a family that we were working with as an example because my suspicion is it may very well be a match to many of the people watching this video today. And so the setup is the husband is 68, the wife is 65, their overall estate exceeds $20 million. There's $1.5 million of money within their IRA that they have yet to withdraw as of right now. And so This slide is designed to talk about and educate the consumer about what the IRA tax trap is, basically reminding them that what we just talked about, they pay taxes no matter what on the balance within that. So we have a cartoon with representation of a jail because from my perspective, the money is kind of like in jail. It's being held hostage because of the tax requirements associated with distributions. And so then we encourage people to differentiate in their mind the difference between the pre-tax value of that IRA and the actual value. So if you notice, I'm sure every week in your practice, you see client net worth statements that they send to you so you can get a profile of their overall holdings. I've never seen one yet on the liability side, for example, that goes ahead and shows a contingent income tax or estate tax liability associated with the qualified plan. It's never done.
Only once in all my years as well. It's just one of those things that people don't think about. And particularly if there's a divorce going on, that I've not found that to be brought into the conversation either. And it should be.
It should be. So the problem with all that is that it's almost like the client, it's not that they lie to themselves, but they deny the existence of the liability that is inescapable. They don't get to escape the tax man, but they don't list it as a liability, causing them falsely to believe that the actual value of that IRA is larger than it really is. Mm-hmm. And so the purpose of this slide is to try to force them to recognize that. And the difference between the pre-tax and the actual value is, of course, the impact of income and estate taxes.
Good point.
So in this particular strategy, we use a product called Indexed Universal Life that protects their money from catastrophic losses because their money is not actually invested in the market. In good years, it resets a new balance. In bad years of the market, they kind of hold steady and they move forward to the next year, causing us to be stable. So that's what the purpose of this slide is. Part of the way this is attractive is that we work with insurance companies that have special loan provisions within the product itself. That allows the client to actually borrow money against the death benefit to finance the payment of the income tax burden associated with recapitalizing a qualified plan asset. That feature is very beneficial because it enables us to gradually restructure money that's yet to be taxed, handle the income tax burden now while living, and transform that into a much bigger balance for a second generation. So in this case, if you're starting with 1.5 million that's never been taxed, if it's in California, it's quite a bit of tax, depending on the income tax brackets and so forth. If we take that money out over a 6-year period of time and create a new account, we can establish a $5.5 million death benefit for the benefit of generation number 2, that if someone is fortunate enough to actually live to age 100, it grows to more than 8 million. So we're taking something that starts off worth 1.5 million before tax. After tax is probably more like 800,000 or 900,000. So your comment of junk money, we're turning 800,000 of junk money into 5 to 8 million of fantastic perfect money, or whatever word you want to use on that. And so that would be the simple way to contrast that. If you're able to begin at a $5.6 million benefit, oftentimes that benefit can help offset any estate tax and income tax burden associated with the other holdings in the client's estate. So what's attractive about this transaction for the right client is they're able to use their least efficient source or holding and turn it into the most efficient, because we can create between 5 and 8 million of insurance tax-free to go to generation 2. And what they're doing is they're exchanging the required minimum distribution requirement over their lifetime in exchange for that death benefit. That's the trade-off. What are they trading? They're trading the requirement of paying themselves an expected stream from that IRA, in many cases that they do not need, to recapitalize the asset outside the estate, free of income and free of estate tax.
It's been said that money is amoral. It's neither good nor bad. As another friend of mine, Valerie Jacobs, likes to say that money makes good parenting better and bad parenting worse. so, if anybody's watching or listening and you're saying to yourselves, gosh, man, I don't want to give my kid $5 million. Well, this is just an example number one. And number two, those numbers were pretty small. I realize that. So don't worry. We can customize these things for your own unique situation. But the point I was going to make is that on that money that Bryan's talking about for Gen 2, maybe even Gen 3, typically those monies we put them into a trust that is now outside the reach of any unknown creditors that might come and try to attach assets of your Gen 2, Gen 3. Also divorce, because in California, but I've heard in a few other states as well, that there are some people that don't stay married forever. So in case you've got money that goes into a next generation, we can also protect that money so that it's not subject to divorce for your children or for your grandchildren or future generations. And three, in California, as most other states, we can only have a trust that lasts for about 80 to 100 years. But there are some other states and jurisdictions where we can go. One of them that has a 365-year jurisdiction, which isn't forever, but I'm told that is a long time. I'm going to take their word on that. And then there are some states as well that have completely repealed their laws against perpetuity. So we can quite literally, create a trust that lasts forever. I got a call from a very wealthy developer in Texas yesterday. We've been working on to get him to move, and yesterday was his day. So he called me up and said, RJ, it's time. But his concern was they've got a new project starting, and they're concerned that maybe somebody might find out and sue them because he's been sued a bunch of times in the past. So he wanted to know if we could actually set up a beneficiary trust where no one could tell who the beneficiary was. The answer is yes, we can. There's only one state in the country. It's what I call the Switzerland of the U.S. But in fact, we can do that so that even the judges are not permitted to release information. So Bryan, when you're talking about this is really powerful stuff because this money is not necessarily just for one generation. It can be for multiple generations, literally for hundreds and hundreds of years without subject to claims of creditors or divorcing spouses or even IRS. If it's properly designed. So back to you, my friend.
That's really incredible about the ability to mask the ultimate beneficiary and keep that private. That's very interesting. I can see how many families would be interested in the privacy aspect of that. That's very interesting.
Yeah, only one state.
So we have a number of, this is one of, I would say, 4 IRA conversion, life conversion profiles. We don't have an example today. It's beyond the scope of today's call, but what we can do is discuss other fact patterns. This would be people in their mid-60s with the objective of transforming the IRA into the biggest balance for Generation 2 and Generation 3. Once a client gets above the age of 74 or 75, life insurance becomes a little bit more cost prohibitive. In that particular circumstance, you might encounter a client that's in their 70s or 80s. What we can do in those circumstances is we can use that client's IRA and take the money and make current gifts to establish life insurance on the lives of generation number 2 to benefit generation number 3. So that if the family is still thinking of this box of money as intergenerational wealth and how they can make the greatest use of it, even if the client in question may be a little bit too old, or if their health isn't good enough to even get any life insurance, so they couldn't qualify in the first place, there's many other options available that we can explore that might very well be of tremendous benefit to those families, like you're talking about.
And Bryan, one of the things as well is because some of these premiums can be quite substantial. They can be $100,000, $200,000, $300,000 a year. And so that could be a big number. 2 things. Number one is we can design these contracts. You can design these contracts in such a way that those that are the grantors, in other words, the parents in this assumption, Gen 1, that if they needed to get access to that money, that they could still access some of those cash values that are in the insurance contract. So it's not like they're just taking that money and kissing it goodbye and not have. So for those folks that are worried about, well, what if we don't have enough? Well, we can put some strings on that money. But the other thing as well is that there are banks out there that are delighted to, in fact, loan money to clients to buy life insurance. So they can do that in very successful ways where the money comes over from the bank. It's used to leverage to buy the insurance. Perhaps the individual just uses some of the money they're taking out from the IRA to pay the interest on the loans. And we can also cap that interest rate. But right now is a great time because interest rates are starting to come back down again. And as we look forward for the next 8 to 10 years, are going to be substantially lower than what we are today. So timing is excellent for this particular concept. But also, Bryan, you've got a very clever idea, and I think we'll be talking about it later this morning in one of our other sessions, or we can certainly talk about it now too. But using internal borrowing within the contract. That you've very cleverly come up with a design that rather than having to leverage using other people's money, OPM, there's money inside those insurance contracts that can be leveraged from the insurance company, which I had never seen before. So again, my friend, you're doing some great pioneering efforts. And so either in this presentation or another one coming up, we'll be talking more about that internal borrowing.
Yeah, we think it's cost, it's really a good value to the consumer because of the life insurance carrier's ability to set two different loan choices as an automatic within these contracts. For example, a bank, there is no such thing as a lifetime maximum loan interest rate that a bank is allowed to charge a consumer. There is no such thing. It's indeterminate. Whereas in the life insurance products, some of the carriers we work with have set 5% is the maximum rate that they're ever allowed to charge on a loan, which that provides the consumer tremendous certainty in terms of how this plan may in fact work over a long, long, long period of time. Imagine if you had a contract from Bank of America saying that whatever money you needed to borrow against your account was at a rate never to exceed 5%. That would be very attractive, wouldn't it?
Absolutely. And especially since you don't have to prove every year, give financial statements or something else to prove that you're still worthy of the loan, which, again, if you're using outside lending, they're going to want to make sure that your portfolio and your balance sheet still looks good.
Yeah, so we think there's some advantages. The privacy, the rate structure, the lack of having to qualify. It is not on your balance sheet, meaning it's not on your credit report. It's a total private arrangement between the consumer and the insurance company. So there are many cases that there's some advantages to some of that. So very good. So we talked about the comparison. We have the capability to populate a representation of the don't do it. In this case, even though the numbers are small, is just showing the client giving up $60,000 a year of income to spend that they don't need, transforming around $1.5 million of projected net inheritable value of the IRA and swapping that to between $5 million and $8 million. So the advantage is 3-to-1 in most age of death scenario, which is what we're shooting for. At age 100, it's many, many times. It's $8 million against $690,000. We have a way to populate presentations that track if I only live to 80, if I only live to 85, if I only live to 90, and so on, what the overall value inside the transaction is so that it's easy for a client to make a determination as to whether there's good value represented here, whether they should do it, whether it's in their best interest to explore something like this. Then back to profiles, I wanted to point out that the other profile of people, it's interesting, is the non-spouse beneficiary who inherits their mother or their father or their uncle's IRA. Since they're non-spouse, they have to take that money out over 10 years, like you were talking about. So for those people, since we know for certain they have to take the money out, it's a slam dunk to reposition into a tax-free product like this to give them a lifetime of guaranteed tax-free treatment for their whole lifetime. So that would be the other profile of consumer that might very well benefit from this sort of a strategy.
Might add one more profile as well, because oftentimes when we're working with clients that are philanthropically minded, which many of our clients are, I'll advise them to leave their retirement assets after their spouse, assuming they're married. But in that case, then whatever's left, to have that go to charity. Because then the charity doesn't have to pay taxes on either income in respect to the decedent or the estate tax. So it's very effective, but your idea makes it even more effective if they instead take the withdrawals, as we're discussing, put them into the life insurance contracts. Now we get some deductions today for contributions that are going to a philanthropic outlet. And then at the same time, when you don't come home that night, guess what? A big pile of money that comes in to your favorite charities, or could be your own family foundation. All of a sudden, you're going to have 3, 4, 5 times as much money being able to be used for philanthropic purposes to assist those organizations that you are on fire about, that really warm your heart. So I would say that's even yet another group that this could be a very applicable leveraging technique for.
I agree. It could be used in that way, or it could be a backstop, a way to replace wealth that they wanted to give from some other source.
Good point.
In their estate to charity. So whether the policy goes directly to charity or whether the policy goes to family for the purpose of replacing wealth, that maybe the client had highly appreciated shares of stock or some other asset that they would like to go ahead and give to charity during lifetime, there is some really good utilizations of the life insurance structure from the IRA to provide all kinds of benefits to wealthy clients. And so I think it's a lot to talk about on this one.
Well, there you have it. So, Bryan, thanks so much for giving us this idea. Lots to chew on here. We're going to have a couple more videos together. And so for those that are liking what they're hearing, just check the next link. But again, with Bryan Setzler. And Bryan, thanks so much for the making yourself available to be with us today here at Wealth Legacy Group. And I'm RJ Kelly. If you liked what you've heard today, maybe you want to look at how this would apply to your situation, you can send an email to info@wealthlegacygroup.com. That's info, I-N-F-O, info@wealthlegacygroup.com. You can give us a call at 858-569-0633. That number again is 858-569-0633. Again, I'm RJ Kelly. Thanks for being with us. We look forward to seeing you on our next spot.